Hello and welcome to SIPS Level 6 Professional Diploma in Procurement and Supply Revision Tips. This is Module 2, Global Commercial Strategy, and it's Learning Outcome 4, which is to understand the financial aspects that affect procurement and supply. So in supply management, it is important to understand the financial aspects that are going to affect procurement and supply. So we look at things like how costs and finance affect the supply chain, the methods to manage volatility in currencies, and managing commodity volatilities in a supply chain. Now, different companies, as we know, have different financial objectives, some about maximising shareholder value and profits and assessing how valuable a company is to a buyer in the market, but others will have different approaches to their funding and to their financial objectives. But we do need to assess how costs and finance can impact on the supply chain. And the decisions reached by a manager of a firm in relation to its finances affects every department, including its supply chain. It affects its firm's operations. And because finances are very limited, the best way to become an important part of the firm's management is to make use of its resources in the best way possible. So the financial objectives of different organisations, you've got value for money versus sort of shareholder wealth. So financial management role is to focus on how significant the financial numbers of an organisation are. So objectives for different companies might be company valuation, maximising shareholder wealth, profits, or a shareholder view implementation. A company valuation is used to determine how much the financial participants of a market are willing to pay or receive in order to sell a business or to buy a business. So the valuation is the process used to estimate what something is worth. Now, when you're valuing a company, you'll look at the financial statements, which are relied upon for fundamental analysis to determine how valuable a company is. So during the valuation process, the firm's items that are classified as either assets or liabilities are evaluated. So your assets could be something tangible or intangible. The tangible assets are physical things that are owned by your business, like land, vehicles, property, factories. And tangible assets obviously are the backbone of a business because they provide them with the means to make money. Intangible assets are things that are not physical. So they're things like patents, trademarks, software, copyrights, and all of these things add value to the business. A business that's owned by shareholders will be looking for the maximisation of their wealth. So these individuals own stock as an indication of ownership. One of the financial objectives of a business is to increase and maximise the wealth of its shareholders, dividends and capital growth. This means they try to increase the value of the stock through price increase. So as the price for a stock increases, so does the value of the firm. So this leads to an increase in the net worth of the people who own it. So some of the indicators of maximisation of shareholder wealth, we'll look at the kind of bonus shares, how much dividends are paid out at higher rates, the high book value of the shares, the rights, the issues of shares at low premiums, and the market value increase of those shares. But in financial management, the main objective of a business is to often maximise the wealth of its shareholders, but that doesn't necessarily mean the same thing as profit maximisation. You know, the profit generated by a company is relatively related, I suppose, to how resources are leveraged in order to make a positive return after the deduction of their expenses and the shareholder equity. And there are some potential problems for profit maximisation. So you've got the long-term versus the short-term problem, and that's because most companies, especially publicly traded companies, have to report their earnings every quarter. And they're often under pressure to make lots of short-term profits instead of long-term profits. But to do this, repairs, trainings, research, development, and advertising may very well need to be cut. So that reduces the expenses in the short term, but in the long term, the company will suffer from lack of innovation or increased repair costs. The second problem is the risk of quality earnings. So to increase profits, a company might be tempted to take a risk, increasing its risk level, but taking on this risk can endanger the returns available to its shareholders. And then finally, cash flow. Since dividends are paid out in cash and accounting profits are only paper figures, investors tend to consider both cash flow and profits. Now, the stakeholder has a view, that in order to maximize its wealth, the shareholders in modern organizations will vary greatly in the type as well as their financial objectives. You'll have equity investors, directors, employees, customers, suppliers, the government sometimes as well. And it's about balancing the different competing claims from those different stakeholders to take into account a broader and social and economic responsibilities. But the cost of materials, labour and overheads is, when an organisation doesn't really know its cost, it's guaranteed to be losing money. So you really do need to understand the cost of your service or product in detail, but that does come with some challenges. So supply chain management, you'll have product costs that are incurred in creating a product with the intention of selling it to your customers. So product costs are divided into the direct material costs, the direct labour costs, and the manufacturing overheads. And in some organisations, transport costs are treated as product costs, whilst others treat them as logistics costs. So we must look at our product costs and also look at the transport cost and the impact that has on the supply chain. But the direct material cost is the cost of the raw material used in the product creation. So if you're a toy manufacturer, you'll be using materials to make the toys like plastic. There'll be indirect materials like cleaning supplies during the production process. They're often excluded from your material costs and they come under your overheads instead. The direct labour cost is the cost of wages that are paid out to employees directly involved in the production creation. So referring to direct labour is often implying that they're hourly wages and that the cost per hour that the employee is paid before deduction is then included within those product costs. But there are other things as well, aren't there, like taxes and other deductions that are made. So most companies will include the fringe benefits like the health in their direct labour costs. And then in terms of manufacturing overheads, you've got the indirect materials like the cleaning supplies, the oil, the tape, the glue, the boxes, indirect labour for your employees that are not directly involved in the production, but they might be doing things like security or advertising. And then any other costs like insurance, leases and utility costs. And like I said earlier, some will put transport costs against the manufacturing overheads as well, or under the product cost somewhere along the lines. But you do need to look at, how much it's going to cost to move the product using the transport choice that you pick. So now looking at funding of working capital and credit insurance, before we explain how to fund or finance working capital, it is important to understand that it's important because there's a difference between working capital and cash flow, which is an important aspect of financial responsibility. And that's the way a business is managing its money and other assets that makes it productive in the best interest of the company. There's information on the different types of working capital, along with some common sources of funding for short-term working capital. So working capital is part of what we call operational capital or operating capital. It represents availability of liquid assets. These are assets that you could turn quickly into cash when needed. So working capital is the difference between your current assets and your current liabilities. Because the current liabilities are things that you owe to other people. It's your debt. And working capital isn't an easy concept to understand. There are lots of definitions which are explained, and there are lots of different things in different organisations. So, for example, if working capital is just about deducting your liabilities from your assets, then it's not going to produce the whole picture, because indeed investors will look at whether or not they should invest in a company, and they'll look way beyond your working capital. They look at the whole organisation as a going concern. So on the top left, you've got the liquidity ratios, the current assets, current liabilities, which help you to understand the kind of financial strength of an organisation. So in this example, company X has 800,000 assets, that's what it owns, and £400,000 in liabilities. So its working capital is the difference between the 800 and the 400, which gives you a £400,000 or dollars working capital. That's a ratio of 2 to 1 because you've got twice as much. You only owe half of what you own, so that's why the ratio is 2 to 1. But in company Y, the assets that they own equals the amount they owe other people in liability, so they've got no working capital at all, which only gives them a ratio of 1 to 1. So the difference between working capital and cash flow is really important that you understand that, because cash flow is the amount of money that moves in and out of a business. And you usually want to produce a cash flow summary for a certain period, either quarterly or yearly. Business owners will look at these words as meaning the same thing, but in these terms, they're used incorrectly, and bad decisions can be made when you're preparing your financial statements. So the key difference between working capital and cash flow relates to assets and liabilities. Every organisation needs to be financially responsible, so managing money and other assets effectively, and must be in the best interest of the business. So cash flow needs to be considered. You can do this, as I said earlier, whether it's weekly, monthly, but it's about showing where money's coming in from and where it is moving out. And the timing of that is really important, because if it's going out before your income's coming in, this could put you into a difficult situation. There are different types of working capital. You've got things like net working capital, which refers to businesses having enough working capital no matter what change occurs in their business. Sometimes this is referred to as permanent working capital, but in fact it's not permanent. The word permanent refers not to the actual working capital, but the level of working capital. The level of working capital is also known as a fixed working capital. So there is no exact formula for calculating this sort of net or fixed working capital. It varies from different organisations, but statistics on your assets and liabilities are really going to help to determine the level of working capital required for an effective and efficient operation of a business. But you divide it into the regular working capital and the reserve working capital. The sort of regular working capital looks at the type of working capital required for the normal course of the business for it to run smoothly. Reserved relates to more working capital that's needed in the event of an unexpected event, like a downturn in the business or a natural disaster. In terms of working capital cycle, this is another important aspect of capital within a business, because the cycle refers to the time it takes for an organisation to convert its assets into current liabilities or current liabilities into cash. So, to calculate this, you're going to need to know what your average working capital is, and you multiply that by 365 days, being the number of days in a year. And that figure is then divided by the annual sales revenue for the business. Now, to shorten your working capital cycle and to be more efficient, you need to manage your cash, your debtors, so bringing money into the business, making sure people pay on time. You need to pay your creditors on time, and you need to manage your stock and inventory levels. So you could do things like reduce the credit you give to your customers, or streamline your processes to make time for inventory to make sales, or negotiate an increase in the credit period from raw material suppliers. And in terms of short-term funding, you can look at overdrafts or trade credits. Trade credits is where suppliers are willing to wait for the payments after they've delivered the goods, but you will need a good relationship with the supplier to do that. You can look at factoring, where you sell your invoices to a bank so they can obtain cash immediately instead of waiting 28 days to be paid in full. You can look at short-term loans. Equity, this is the money invested in businesses from personal resources, families or third parties, or take out a working capital loan. But this is for daily operations and not for purchasing long-term assets. And the sources of finance can be internal or external. So some of them are obviously coming from internal sources. They're assets owned by the business and no longer needed, can be sold to release cash. And the external sources could be loans, debentures, mortgages, grants, or looking for hire purchasing or leasing agreements. But on the bottom left, you can see the relationship that produces working capital. So your assets are on the left, your liabilities are on the right. So the liabilities could be bank overdrafts or, any payable funding. And on the asset side, you've got the cash in the bank and any inventory receivables and any required funding to reduce your asset levels. Now, in terms of financing strategies of working capitals, this is also known as a working capital policy or approach. So it's the management of the levels of your current assets to maximize the long-term profits. So to determine which working capital finance method to use, the managers use three basic strategies: the aggressive, restricted approach, the moderate approach, and the conservative approach. So the aggressive or restricted approach on the left-hand side is a short-term borrowing strategy, the most risky way to finance your working capital because it doesn't assume that a company can meet the spontaneous needs that demand working capital. You can have seasonal fluctuations that are financed through short-term borrowing. Now, the advantage of this approach is that it does enable interest expense to be reduced. This makes financing cheap, which increases the profitability of a company, though ideally there should be no need for debt. The downside is it carries a greater risk of all the financing strategies because a business using this strategy is constantly being exposed to risk because it puts the business in a vulnerable position if the short-term borrowing is interrupted. So you've got the long-term financing being through your fixed assets or permanent working capital, and short-term finances being through your permanent working capital or your temporary working capital. Now, the moderate approach in the middle is middle ground between the aggressive and the conservative approach. This approach is known as matching or hedging approach because it's matching your assets and liabilities to maturities. And, these maturities in finance terms means the maturity date that the final payment is due on a loan or a financial instrument. So this approach is taken by a company in using sources of long-term finance to fund things like fixed assets or tangible assets, like property, equipment and plant, or permanent current assets like buildings. So permanent current assets differ from current assets because I suppose the current assets are liquid assets which can be easily turned into cash. So to calculate working capital funding using the moderate approach, the company will look at both long-term and short-term financing. But the long-term financing will be used to fund permanent current assets and non-current assets, where the value will not be realised within that financial year. The benefits of this approach is that it has a lower risk linked to the interest rates and investment compared to the aggressive approach. And that's because temporary working capital uses short-term finances, but the drawback is that it offers lower profitability due to the higher interest paid because the long-term financing given goes to finance permanent working capital. And then the other one is the conservative approach, where the level of current assets are kept at a high level to ensure a smooth operating cycle with no risk of bankruptcy. In a conservative, relaxed approach, businesses use long-term financing for the portion of their temporary working capital. The temporary working capital and the non-current assets, any emerging needs are met by short-term financing. So this approach leads to a higher solvency and liquidity level, which means a business is able to easily access short-term finance to cover its working capital emergency needs. But the drawback is there's lower profitability due to higher interest it pays in the long term, which is obviously more expensive than short term. Interest expense due to long-term finances, even when a business doesn't need temporary working capital, and a lower asset turnover resulting in a lower return on investment. Now, project funding is separate from all other forms of financing discussed, And this is because it relies on the profitability of a given project to repay the fund. So the cash flow is used once the project becomes profitable. If not, the asset of the project serves as collateral. So once a project is deemed feasible, the loan of project funding is granted, which is serviced through the project revenue. So it's structured as a long-term finance option because it needs an extended time from project to start finish. But in the private sector, it's often to attract project financing because firms are in a position to fund major projects which they would undertake without reporting it on the balance sheet. So there are a number of ways to finance your working capital, and it's divided into internal and external methods. Internal methods is about managing your inventory, payables and receivables, but obviously external ones is about borrowing money. So these methods are discussed as firstly trade credit. This refers to the credit period extended by creditors to a given business, more time to make before making payments. It's given to credit-worthy firms who are able to repay and has a good record of payment, liquidity and earnings. You've got cash credit, a short-term loan company to get money from, like a bank. The loan is given against collateral security, and generally banks will only provide these loans to cover specific purchases like stock. They're then a funded form of finance that allows the borrowing company to withdraw funds that exceed the credit balance it has. Bank overdrafts are extended overdrafts to a business, which allow a business to withdraw funds that exceed the balance in their account. And they provide this service for a fee, which means that interest is charged on the excess amount withdrawn for a specific time. Invoice discounting is a short-term financing method that companies use to borrow money from financial institutions based on their invoices. Short-term bank loans are a bank promises to pay a given amount of money to a seller or beneficiary should the buying or company default to pay the beneficiary. So the bank or financial institution gives a written instrument to the seller on behalf of the buying company. And then factoring involves a company selling its accounts receivables to a third party for a lower price than the real value of the accounts. This in turn leads to the third party providing finance to the borrowing company and purchasing its accounts and collecting the revenue from the debtors. And in today's ever-changing business environment, the controlled practices of traditional credit doesn't guarantee company protection against making losses. This has led to new funding tools like credit insurance, which helps companies to protect against their accounts receivable. And whilst most companies insure against their manufacturing plants, equipment and other tangible assets, many don't insure against their accounts receivables, which often can be, on average, 40 to 45% of their assets. That leaves a company vulnerable on a day-to-day basis. And some of the reasons customers might fail to pay their debts could be because of corporate insolvency they face, changes in the use of financial institutions, liabilities, cash flow issues, new legislations, disasters, fraud, or any issues either domestically or internationally. So in terms of how the credit insurance works, you've got the trade credit going between the customer and the company that's insured. You've got the credit insurance between the insurer and the company that's insured. And the risk and collecting of the debt goes between the credit insurer and the customer. There are obviously advantages and disadvantages to this approach. I mean, from an advantages perspective, it helps a company to have cash for temporary working capital needs, protects them from risks beyond its control, like, political or commercial risks, reduces the risk of sudden or unexpected insolvency of a customer. It insures them from non-payment as well as collected debts. And it helps a company safely increase its sales without increasing the risk because it's free to extend more trade credit to more customers. And it protects an organisation from any catastrophic losses. But the downside is a company cannot get credit insurance on all customer accounts, especially the high-risk ones. Insurance policies have an annual per loss deductible, like an excess, I suppose. And because each credit insurance is limited to 12 months, it means that policies has an annual cap. And when that cap is reached, all the bad debt is often written off above a limit and not covered by the insurance. Financial options can be classified according to the time period needed before the money is required. So you've got long-term, short-term and medium-term. Long-term financing means the capital required are for more than 5 years, and it can take up to 20 years or more depending on other factors under consideration. So this form of financing is often used in the purchase of fixed assets like land, machinery, building and plant. Some of the long-term financial sources will be equity shares or share capital. You introduce capital to a company from its shareholders, and it's a long-term option because it's not redeemable. Share capital is namely preferred stock and common stock. The common stock is often defined as in the country that the company chooses to incorporate its shares in. On the other hand, preferred stock gives shareholders a fixed dividend amount. You've got debentures, the agreement that a company enters into with a debenture holder to get finance. It's a sort of form of a bond, like a loan, that has no collateral. There are two main types of debentures. You've got convertible debentures and non-convertible. The convertible ones are bonds that can be changed into share capital or equity shares of the issuing company after a predetermined time expires. The non-convertible ones are just regular debentures that cannot be converted into share capital. And because of that, their interest rates generally are higher than the convertible ones. Bonds are instruments to borrow money from financial institution. And when it comes to bonds, they're the most common form of debt that are used by organizations and governments. Now, bonds are used by companies to secure finance because they're often considered relatively safe to invest in. Those issuing the bonds are often highly rated companies or governments, which are perceived to have very little likelihood of defaulting on the payment. Term loans are borrowed from commercial banks and governments. When a company decides to use term loans to finance its operations, it can do so by buying equipment or assets to use the long-term finance for. Sometimes they're secured, which means there's collateral against them. Other times they're unsecured. And then venture funding provided by venture capitalists are a form of ownership of the company. This forms part of permanent capital. They're often used by companies to get financing when they're mostly startup companies and think they have the potential for long-term growth. In terms of medium-term financing, this is required for a period of between 3 and 5 years, and it's often carried out for two reasons. When the term of an asset or purpose is medium-term, and when a company has revenue expenditure like advertising that needs to be written off within 3 to 5 years. Medium-term financing also will include the debentures, the bond, and medium-term loans, but the ones that we haven't talked about is lease finance and hire purchase. So lease finance, what will happen here is a company will use an asset from a leaser in exchange for a periodical payment, like a lease payment. But since the asset belongs to the leaser, at the end of the lease contract, the company that was using it has to return the asset. You can do this by a finance lease or an operating lease. In the finance lease, the leaser transfers all the risk of the ownership and the asset to the person that's leasing it, the leasee. In operating lease, the leaser doesn't transfer the risk. And then you've got a hire purchase where a company hires an asset from an owner and makes regular installments towards the complete ownership of the asset. And then short-term financing, where companies are seeking to finance for very short periods, which could be less than sort of 2 years, 24 months. And often you'll seek this type of financing because you've got a problem with uneven cash flow in the business, or there's a seasonal pattern that needs working capital during lean months. And that can be done by commercial paper, which is an unsecured short-term debt that is given by a strong corporation. Companies issue the commercial paper in multiples of like $100,000, and the time duration is between 3 and 270 days. and you can opt for these papers over a short-term loan because the interest rate is much lower, 1 to 3% below the bank rates. Short-term loans typically given by a bank, two main types again, unsecured and secured. One's secured against some collateral and the other one isn't. You can have business lines of credit, which is where businesses is given an amount of credit to pay their bills over a given time. Accounts receivable invoicing. This form of financing allows a company to borrow up to 90% of the amount that they are owed by customers with outstanding invoices. And in most cases, this form of invoicing is paid back within 90 days. And overdraft protection. You'll access short-term financing through overdraft protection, which is often useful when cash flow is low and a company overextends itself. Now, because financial management is concerned with acquiring and developing both long and short-term financial resources to achieve its objectives, it becomes important to have decisions taken in respect of a firm's capital structure. And this could be an investment decision, a dividend decision, or a financing decision. Now, on the right-hand side, you can see how financing decisions work. You've got the equity and debt coming in at the top. You've got money going out through the firm at the bottom, which is either, investments in non-current assets, working capital, or dividends. There are three factors in investment decisions. You need to think about your cash flow. A new venture requires a firm to invest large amounts of capital in order to start up. Profits, when a business is deciding on which venture to invest in, it must determine the venture's rate of return. And then investment criteria is used to choose the best investment proposal based on lots of different processes. You come up with the best proposal having taken into account the investment rates of return, and your cash flow. Now, in terms of financing decisions, it's concerned with how a firm should acquire funds, when is the best time to do so, and how to go about it. The factors that affect financial decisions will be your cost, since the cost of raising investment funds depends on the source being used. It's best to find the most cost-effective source for the firm. And then in terms of risk, you need to determine the amount of risk it is able to take, because that would inform the financing that you get. The cash flow position. A good cash flow position gives investors confidence in the finance of the firm, while bad cash flow disencourages the investors. Then control. When a company investor wants to have control of the business, borrowing is preferred as a source of finance, but shareholders are prepared to dilute their control. And then market conditions is when a market is booming, equity is a preferred way to finance. But when a market is depressed, firms will use debt. And then the dividend decisions relates to how profits are distributed to its shareholders. So it's going to relate to the profit earnings and the distribution. And the factors affecting the dividend decisions will be earnings. They're paid out both on past and present income, and how much investors are paid per share. The earnings dependability is whether a firm that has stable earnings and higher profits are able to pay out dividends that are higher compared to organisations with lower earnings that are less stable. In terms of balancing the dividends, you must be consistent and balanced out. If not, it might affect a company negatively when high dividends are paid out at the expense of retaining profits to support your operations. And then deployment opportunities is where a company is more likely to invest in opportunities as they rise, as if the money was retained from its earnings. So without it, a company is not able to invest in many opportunities because it will run into financial problems. All right, we're now going to look at the methods for managing the volatility of currencies. So countries no longer operate in isolation from one another. For them to continue and grow, they must engage in international trade. And because different currencies or different countries have different currencies, it becomes important for each country to decide the best foreign exchange regime to use. There are three main foreign exchange rates. You've got fixed, floating, and pegged. In a fixed exchange rate regime, a country fixes its currency trading value to an underlying financial instrument like gold. It can also be used to fix against another currency. The floating currency allows the country or the local currency to fluctuate depending on market forces like supply and demand. But in the pegged foreign exchange regime, the local currency is pegged against another currency that is stronger than it, whilst being allowed to fluctuate within a given range. So in other words, the exchange rate is a comparison of the value of one currency with one value to another currency. So for example, the British pound is exchanged with another currency, for example, the United States dollars. So when traveling to one country, a person needs to buy local currency in order to do some business. Essentially, they're buying the price of another currency, just like they would with an asset. So you can see how this works. You've got the floating exchange rates where you've got market forces, which will lead to either a floating rate regime or a pegged rate, or a targeted exchange rate where monetary authorities determine the rate, and that will determine either a fixed rate, again, or a pegged rate regime. The fixed rate advantages is that currency inflation is avoided. It helps firms because currency fluctuations lead to problems making exports uncompetitive. It helps the businesses to encourage investment because it acts as an incentive for companies with international supply chains to export. It encourages companies to keep cutting their costs and remain competitive because inflation is kept low and the pressure of devaluating the currency is a minimum. But the downside is, other macro objectives may conflict with the fixed exchange rate. So higher interest rates tend to reduce economic growth, and that can cause a recession. It's less flexible because fixed rates have difficulties responding to temporary market shocks and the difficulty in maintaining the value of the currency. With the floating exchange rates, the advantages there is it follows the ideology of free trade and supports efficiency by allowing for demand and supply to happen. Bodies like central banks don't need to actively intervene to manage it. And it displays the value of the nation's currency in the long run through the exchange rate of prices. But the downside, it is highly volatile, which means it can depreciate or appreciate with large fluctuations, and that can disturb the stability of foreign exchange. And it tends to make existing problems such as inflation worse. The floating exchange rate reduces the need seen in fixed exchange regimes for foreign reserves. It gives countries the freedom to set their own interest rates to meet local objectives, helps to reduce or prevent import inflation. It insulates a company's or a country's economy from external shock. And it's not a risk to speculate attack because its currency value is truly reflected. But the downsides is this is an inward investment confidence due to uncertainty in currencies. With fixed exchange rates, the costs incurred by companies are due to currency hedging, which are reduced, and that's pretty good as well. It comes with some control of inflation, providing stability, helps businesses to keep their costs low. It yields lower borrowing, and it's a fixed rate in a credible country, which can allow for lower speculations. And then looking at the pegged exchange rates, the good thing about the pegged rates is that a country that pegs its currency is able to lower its inflation rates as well as generate demand. And that increases confidence in the currency. The country export benefits if its costs is little to produce in a country compared to others. And if you opt to produce goods in a less mature nation for lower costs, then this is translated to the domestic currency of the lesser nation, and of course translate to larger earnings. It supports rising standards of living because a pegged exchange rate stimulates economic growth, and a country is protected from currency crises that cause volatile swings. But the downside is the country must maintain large reserves of foreign currency in a central bank to maintain the pegged currency. The large reserves can lead to or spark an increase in inflation. That creates problems with economic stability, and the central bank is forced to buy and sell local currency in the open market. Now, the value of currency that belongs to a given country is influenced by different factors that are related to the economic conditions. So if we take the US dollar as an international standard against which currencies are measured, it will be found that the exchange rate leads to more value, whilst other countries are less value compared to the dollars. Now, essentially, the exchange rate comes down to supply and demand, which are fundamental principles of economics. So when a foreign currency supply more than required or demanded, the value decreases. If it is a shorter supply, the value goes up. And there are two main areas that we look at, the factors that affect demand and supply for foreign exchange, and the reasons that leads to the volatility of the exchange rate. So the demand and supply factors, you can see they're on the right-hand side of the screen, and I'll just go through a few of them. You've got things like inflation rates that cause the currency to change. If inflation in a country increases, the purchasing power of the currency reduces, and that lowers the value and creates less demand. So on the other hand, a country with low inflation rates is able to see the value of the money increase. In addition, when the inflation rates are low, price for goods and services appreciate at a slower rate. So how inflation lowers the value is the inflation levels rise, purchasing power of the currency then reduces, less demand for the currency, and the value of the currency therefore reduces. If we look at interest rates, when an interest rate changes, it affects the currency value in a country. This is because the forex rates, inflation and interest rates are all correlated. So the interest rate that increases will result in an appreciation of the country's currency, because the higher rate gives lenders higher lending rates. That attracts foreign capital, which leads to an increase in the exchange rate. So how interest rates affect currency is the interest rate increases, capital appreciates, you get higher lending rates, more foreign capital, the exchange rate then rises, better return on investment, currency demand rises, and there's a rise in the currency value. A country's current account, this is a definition given when an account that reflects the balance from trading. So it's made up of transactions like imports and exports, as well as debt and other things. The current account is tied to a domestic currency and fluctuates depending on the current account surplus or deficit. A deficit shows that the country's spending more than its country's importing products or earning from its export, and that causes the currency to depreciate. When a country has a deficit, it requires more foreign capital. So how a country with high deficit will lower its currency is the import exceeds exports, the deficit is created, local currency demand decreases, and there's a surplus of the local currency, and local currency value therefore decreases. In some situations, government debt can influence the country's exchange rate. One of those circumstances is when there is a fear in the market that a government will default on its debt payment. When investors become fearful, they sell off their bonds and get rid of the local currency. This leads to the value of the currency falling, and you might find it difficult to secure foreign capital. That can lead to inflation. So the government debt can lower the value of your currency or your country's currency from starting with the fear of the government defaulting. Then investors will panic and sell their bonds. The local currency value falls. You get difficulty securing foreign capital and a possible trigger to rise inflation. Terms of trade is related to a country's current account. It represents a ratio between the price of exports and the price of imports. So if the import prices are higher than if the export prices are higher than the import ones, a country's terms of trade improve. This is because higher exports lead to higher revenue, which in turn causes the demand for currency in that country to go up. So how terms of trade increase the value is it starts with export prices higher than import ones, more revenue generated, local demand for the currency increases, value of the currency goes up, and exchange rate of the currency rises. Political stability. The political state of a country affects the economic performance of the nation. So a country that has less political turmoil is far less attractive to investors than one with more. So as a result, investment capital increases. This leads to more local currency value rising. In other times, though, a country that is in constant political turmoil does not get a lot of foreign investment. The constant political turmoil sends confusing messages which leads to a depreciation of the value of the local currency. So the political stability increases the value of your currency, starting with less risk of political turmoil, attracting foreign investment, foreign capital increases, and the value of your local currency goes up. Government intervention, the manner in which governments buy or sell its own currency influences the exchange rate of a local currency. And when a government wants to keep its local currency lower to attract investors so that businesses can increase their exports, it exchanges its own currency for a foreign currency that's stronger. So it will start with the government exchanging local currency for the stronger currency. Foreign investors in the country export products cheaply, and then local currency values keep lowering internationally. And then we've got recession. Recession is when the country is hit by a recession, the interest rates fall. This reduces the likelihood of acquiring foreign capital. As such, the currency weakens compared to other countries not experiencing the recession. So the recession hits the country, interest rates will fall, foreign capital reduces, the currency then weakens, and the value of the local currency goes down. And then speculation. Investors influence the exchange rate of local currency because they speculate on a given market. And if investors think the country or the economy of that country is rising or improving, they tend to invest heavily in that country's economy or their local currency so they can make a profit somewhere in the future. This causes local currency supply to decrease, which of course increases its value. So it starts with speculation that the economy is growing. Investors demand and buy the local currency. Demand increases the local value. And the reasons why we get this exchange rate volatility can sometimes be because of trade movements, capital movements, stock exchange operations, speculative transactions, bank operations or monetary policies, political conditions, and exchange rate regimes. Now, before discussing the different foreign services, it's worthwhile noting that the banking sector falls under the financial sector within commercial services, being the foundation of the financial services group. In addition to banks, there are many financial services that are not banks, like stock market brokers, investment agencies, and foreign exchange services. The foreign exchange market is also known as Forex or FX or currency market. And the brokers enable traders to access foreign exchange markets for currencies. It's the most liquid financial market, with those being involved in governments, central banks, commercial banks, financial institutions, investors, speculators, commercial operations, or even individuals. But the derivatives are the underlying asset that's used to determine the price of a derivative. So when the price changes, so does the derivative. It's a security that's needed, an underlying asset to determine its value. So in the foreign exchange market, the foreign currency derivative is one that depends on two or more currency exchange rates. They're used to hedge the risk of foreign exchange or arbitrage and currency speculation. And some of the derivatives include futures, options, forwards, and swaps. The reason that these instruments are termed as derivatives is due to the fact that their value is derived from an underlying value, in this case, a foreign currency. A company purchases these foreign exchange derivatives so that they can reduce the risks which come with cash flows. So they're used to hedge the risks of exchange rates, taking the position that they'll make a profit and attribute or speculate. Whilst they're powerful tools to use, especially when hedging the foreign exchange rate risk, these derivatives are very highly risky instruments because a company that has experienced or has inexperienced managers could be leading to sort of bad derivative trading, and that leads to losses for a company or even bankruptcy. So futures are financial contracts that obligate a buyer to buy an asset or a seller to sell an asset at a later date at a price that's determined. So you can leverage the price, I suppose, compared to the stock markets. A futures contract is, well, it has a few specifications. The quality of the commodity must be standards that are met. The size of one future contract is established to determine the unit of a commodity that will be traded per contract, and the delivery date is set on the day or the month that the commodity is delivered. Now, forwards contract is formed between two parties who want to sell things to one another or to buy an asset for a specific price and date. As such, it's used to speculate or hedge a commodity, although it is not standard like a future. This non-standardization makes it particularly good for hedging. So the forwards contract market is big because many international businesses use it to hedge their risks with interest rates and currencies. And because they're not general public knowledge, they are restricted to only the buyer and the seller and the bank. So it's difficult to estimate the forwards market. Now, options are derivatives that give a buyer or seller the right to buy or sell an underlying asset at a future date, and that's at a predetermined price. If the buyer buys an option from a bank, they're not obliged to execute it. But if they decide to do so, the bank is obliged to settle. And then swaps is an agreement that's made between two parties to exchange money on a predetermined date or multiple dates. Normally, one party pays a fixed rate while the other party pays a floating rate. Unlike standardized options, the future swaps are not exchange-traded instruments. Instead, they're contracts that are customized and then traded because private parties in the over-the-counter market, they swap and carry the risk of one party defaulting on the arrangement. A normal currency swap will be two parties swapping or exchanging principal amounts at the beginning or the end of the swap. And the simplest and most common swap is known as a plain vanilla interest swap. So payments are made in the same currency. Now, banks provide a number of services in foreign exchange, determining the exchange rate, stabilizing the market, trading and speculation, managing purchasing and selling currencies, providing liquidity and credit services, external trade and hedging, and managing foreign risk. So central banks are indirectly affecting the exchange rate of domestic currencies through the decision they make regarding their fiscal policies. So I suppose direct intervention is another option for central banks by intervening in foreign exchange markets by trying to stabilise the market and control the supply of local currency, inflation and interest rates. They do some trading and speculation because it helps to determine the bidding and asking prices for their currencies. Managing purchasing and selling of the currencies. And that's where banks try to make a profit with the margins of buying currency and selling currency. Most are trading benefits in the bank's current accounts. Providing credit services and liquidity. For example, a credit and liquidity might just be needed by a number of countries or central banks. And they can take action together to enable indirectly affecting individual companies' liquidities. Or external trade, these banks control the amount of currency that's available, and in some cases, they can devalue the local currency by pegging it to a stronger currency. hedging and managing the foreign risk, and then the foreign exchange services that are provided by the banks. That can be foreign exchange currencies when required, as banks can move money easily between currencies, or the hedging tools to help minimize the risk of exchange rate fluctuations. Assessing and managing the risks as the banks have liquidity in major and emerging currency markets, protecting against fluctuations and managing the organization's balance sheet exposure, advising on emergent currency trends, identifying and managing current exposures, developing foreign exchange situations, or even forecasting with more confidence, which in turn minimizes risk of fluctuating exchange rates. They can do in-depth FX assessments and experience setting up foreign exchange accounts and developing policies for FX due to having an in-depth market insight. Sending and receiving international payments in different currencies electronically, which streamlines your processes, reduces costs and errors, and access to pricing and trade execution across zones, and customer service, specialized knowledge and support. So what can supply managers do? They can agree with its suppliers on a baseline exchange rate. They can understand the exposure suppliers have to foreign currency, be in a position to measure the risk, and use that risk management tool and mathematical predictive models to determine the volatility of current exchange or foreign exchange. Keep multiple suppliers of its raw materials locally and overseas, so you can switch depending on the best value. Assess the currency transaction fluctuations to the pegged currency and determine whether to hedge by trying to balance purchasing and selling using the same currency. They can also determine if they should use in-house banks, so to have control over the foreign exchange risks, or through hedging techniques that leverage both short and long-term positions. Now, in economic theory, the demand and supply of a product determines its price. If a commodity supply is more than demand, then prices fall, and in the same manner, price increases, then demand of the product is higher than the supply. But in a marketplace, there is equilibrium for a product which neither the supply or demand exceeds the other. So the volatility of commodities in supply chains means that businesses must adopt several strategies to mitigate against them. So the first one is adopting a more demand-driven planning strategy based on real-time demand. So here you'll be trying to predict in order to come up with the right contingency planning for your supply chain commodity. And that's because you can see a whole view of the volatility of your commodities. The second strategy is adopting an agile and adaptive supply and supporting fast execution. In years past, supply chains used to wait until the end of a specific time or quarter before changing production. However, they're very costly for companies, and in some cases they incurred heavy losses when the commodity volatility changes were sudden. The third strategy is to optimize product design, manufacturing, and supply. This cost must also be factored in accurately and captured to help product innovation and optimize even during volatilities. In addition, it will also inspire product innovation through the selection as well as the management of the entire network. And the fourth strategy is ensuring a reliable and predictable supply. Now, normally companies tend to hold inventory buffers so they can meet customers' needs, but this is costly and at times leads to the wrong products being realized or released in the wrong market. So it's important for a company to have a reliable as well as predictable supply despite commodity price volatility. If a company is unable to have a predictable supply, then the cost of doing business will be high and with the wrong products and the wrong demand. Now, certain commodities are found or produced in specific parts of the world. And because of the nature of commodities being raw, agricultural, or basic resources, they're subject to extreme price volatility and can be exposed, or they can expose a buying organisation to greater risk. So the factors that make commodity prices volatile will include things like poor weather, limiting production or supply of a commodity in droughts or floods. Production glut, which is immediate or future supply exceeding demand. If there's unexpected good crops of soybeans, or if soybeans suddenly attract higher price than cotton, more soybeans will grow than there will be demand for. And then you've got oversupply, where the current supply and retained inventory exceeds demand. So if a commodity was stockpiled against a future presumed shortage that didn't occur, or reduction in demand because of a change in a major buyer usage of the commodity, a change in the price or growing extraction, the commodity. You've got political instability in the instances like government interfering, like workers' strikes and war, which limit the production and supply of a commodity. So the Gulf War had a massive effect on the global oil price, for example. Or investors' behavioural patterns. The market is very sensitive to investor and trade behaviour, which can cause a trend to buying or selling, thus affecting price. So in economic terminology, the supply of perishable commodities is relatively inflexible. Simply, it cannot respond easily to a change in demand. For example, if a crop is destroyed or has poor yield, it cannot quickly be regrown. If buyers cannot source a substitute, they'll have no option but to wait for the next harvest. And when a commodity is durable, it can be stockpiled fairly easily. And supply is fairly elastic, so it can simply be reduced in response to smaller demand. But increasing the supply of durable commodities is only possible when it's been stockpiled. For example, if a market was to see a sudden increase in demand for copper, new sources of supply will take time to develop and bring on stream. So commodities are usually sold via futures contracts on regulated exchanges rather than on spot markets. The futures prices of a commodity can be higher or lower than the spot price. And when a futures price is lower than a spot price, this is termed backwardation. When a futures price is higher than a spot price, this is known as contango or contagnation. Now, commodities can be sold as raw materials or can be semi-produced and further classified as hard or soft. Hard commodities are materials or metals that are mined or extracted, like gold and oil, whereas soft materials are agricultural goods that are grown, beef, soybeans, those sorts of things. So to be traded as a commodity, certain requirements must be fulfilled. Products must be easy to grade and storable. There must be multiple buyers and sellers of a product to ensure liquidity in the market. Products must be fungible, which means they can be swapped for another asset of the same type. And there must be price volatility. So an asset must be a standard grade or description to qualify as fungible, so that where the commodity was produced, it has no effect on the commodity price. A commodity exchange needs infrastructure, clearing mechanisms, a legal framework, and contract speculations. So here we can just see some differences between commodities and differentiated products. I mean, in a commodity market, a product is a commodity when its production units are identical regardless of the company that produces them. So a stack of rice from Pakistan is the same as one from India, as long as they have the same grade. In a commodity market, they're treated as one. But a differentiated product is one that a company has decided is different from those of its competitors. And you can make these differentiated products from ones in the market in a unique way that makes it different from those of your competitors. The company then can claim its product can be different or superior, which can, of course, demand a higher price. So this makes it clear how commodities differ from differentiated products. So a commodity is fungible, which means it's exactly the same as something else. Commodities are raw materials like corn, wheat, crude oil, copper. They can be traded using spots, futures, and forward contracts. And those who produce commodities are price takers. This means the individual producers and farmers or companies do not control the pricing of their commodity. Therefore, on the day they have to make the offers, they take what the commodity is worth at that moment in time. The differentiated products is a product that is different and unique from the competitor's product. They tend to be finished goods like laptops, sold directly to consumers, and the company controls the pricing. Therefore, they're known as price makers, meaning they can charge whatever they want. But customers are only going to buy the asking price of the company if they value the product. If not, they won't buy it, which then forces the company to reduce its prices. Now, in commodity markets, investors are either doing speculation or hedging. Since speculators take financial positions, they do their homework. They're constantly monitoring as well as analysing the technical and fundamental factors that might affect the commodity markets in which they trade. So a speculator or speculator in a commodity market, a speculator doesn't actually handle the physical commodity. They take the financial position either in the short or long term with the expectation that they'll make the profit from the movement of the commodity's price. So you make a profit from the difference between the buying and the selling price. Hedging helps both producers and buyers manage the risk of commodity pricing. They match the actual supply contract they're engaging in, which is taking place in the cash market, with a counterpart in a futures market. Any price movement in the supply contract is matched by the movement in the futures contract. So the difference between hedgers and speculators is hedgers do not seek to make a profit, whereas a speculator does. Hedgers seek to reduce the risk by stabilising the cost, but speculators are seeking profit from placing their bets on how the price of a commodity will swing. Hedgers, they gain or lose the underlying asset, which is offset by corresponding gain or loss somewhere else. But the speculator is not interested in an underlying asset or taking possession of it. Hedgers attract forward contracts, and speculators not very attracted to the forwards contracts. Now, in practice, the process of hedging is more complex than we can see on a sort of, large and international trading markets. They've created this to facilitate their requirements, but this is showing you some methods that can be used by an organisation to hedge against currency fluctuations. These facilities would normally be provided by companies in the banking sector for importers and exporters. So a spot price, currencies are traded on the market with published prices. So a spot method means deciding the exchange rate at a particular price. Forwards contracts are made individually between a buyer and seller to set a currency exchange rate at a fixed price, but where the transactions will not take place until a future date, such as delivery of a product with a lengthy lead time. The forwards price will be based on the spot price and the likelihood of it changing. Futures, these are like forward contracts, but rather than private arrangements, they can be traded on the foreign exchange markets. Options, where the two previous methods are contracts and therefore have obligations, options perform the same function, but with a right that could be exercised if either party wants to, rather than a contractual obligation. A premium is paid at the start of the purchase of the right, but the amount made or lost on forwards and futures will depend on the spot prices. And then currency swap, both parties exchange an amount of currency with each other so that the losses and gains from changes are spread equally. Now, it's a popular form of derivative trading, this CFD or contract for difference. The trading enables you to speculate on the rise or fall of prices in fast-moving global financial markets or instruments like shares, indices, commodities, currencies, and treasuries. There are lots of advantages for trading commodities using CFDs compared to using future contracts. Depending on the commodity, with a futures contract, there is the possibility or risk that you'll have to take delivery of the underlying. But with a CFD, you don't own the actual gold or the oil or the commodity. You're simply trading the price of these commodities, but you're always getting a cash settlement. You will never run the risk of a truckload of lean hogs being delivered on your doorstep. So with the contract for difference, you also have the inherent advantage of trading commodities on margin, which means that you only have to deposit a small percentage of the overall value of the trade with the CFD broker. By taking on the whole profit and loss instead, you're likely to find the margin required for trading CFDs rather than futures is much lower as a percentage, which means you'll pay less for the position in the same amount of commodities. However, the main reason you'll pay less when trading commodity CFDs is that you do not have to take the standard size traded of the futures market, which can be substantial for a small trader. In most commodities, CFDs mirror the futures market, but trade in smaller units, which makes it easier to manage risk. And that's the end of Learning Outcome 4 and L6M2 revision tips. Thank you for watching.